Good afternoon, ladies and gentlemen, and welcome to the Proximus conference call on the Q2 2022 results. For your information, this conference is being recorded. At this time, I would like to turn the call over to Nancy Goossens, Director, Investor Relations. Please go ahead.
Thank you. Welcome everyone to this results presentation. Let me just quickly introduce you to participants on our side. So we start with the CEO, Guillaume Boutin. He will open the session with an introduction. After that, we turn to your questions. So for the Q&A, we are also joined by the CFO, Mark Reed, Tim Castelen, the Residential Segment Lead, Anne-Sophie Lotgering, the Business Segment Lead, the CTO, Geert Standaert, our Corporate Affairs Lead, Dirk Libaert, and Matteo Gatta, the CEO of BICS. So they will be taking your questions in a moment, but first Guillaume will take us through the highlights of today. Guillaume, please go ahead.
Thank you, Nancy, and also welcome from my side to this conference call covering the Proximus second quarter results. Next slide. In the next 10 to 15 minutes, I will take you through some of our key achievements, the progress made with respect to our Inspire 2022 strategy, and of course, a quick overview of the second quarter performance. So starting with some of the key achievements over the past month. Overall, I have to say I'm proud of our trajectory so far, with first, and again, some meaningful steps taken in our strategy. I will walk through some of them later, but two key steps for sure have been the strong position we have obtained in the spectrum auction, and also our announced ambition to further broaden our fiber rollout. Secondly, even though the quarter was commercially less active, we continued to see a strong commercial momentum for Proximus. And the last point, we achieved over the past quarter a strong set of financial results, with group revenue up by 4.9% and direct margin up by 4.7%. Year-on-year growth levels we have not seen for a long time. And as we are closing a strong first half of the year, we feel comfortable in raising revenue and EBITDA metrics on our guidance. This slide sums up it from a financial perspective, with the revenue growth translated into higher direct margin for both our domestic segment as well as for BICS and Telesign. The group EBITDA was up by 0.9%, with especially BICS closing a strong second quarter. As already mentioned, we have made significant progress in our strategy, and this has also supported Proximus in becoming much more resilient in a changing market. And I think we are very well positioned to continue winning the domestic market. We'll further strengthen our mobile network, which is already today recognized as the first in terms of quality. We are turning our fixed copper network into a fiber network, known to be the best technology available, and we will have undisputed product superiority on fixed, mobile, and conversions for our customers. And you all know how important it is to have product superiority in that industry. We have a residential customer base that is highly convergent and is addressing customer needs through different brands. This includes fully fledged premium offers, but also low-cost offers for price seekers. And last, our business segment is supported by a very strong telco customer base with strong upsell potential to IT services. Our NPS results progressed further in the second quarter, leading to first half NPS levels shown on the graph at the bottom left, with a nice improvement across our three brands. The increased level of customer satisfaction also supported the price changes we have put through the year. Overall, this has landed well with no material increase in churn levels. Turning a moment now to the outcome of the spectrum auction. Overall, we are very pleased with the amount of spectrum obtained. Out of the spectrum in which we could make a difference in the auction, we obtained half of what was available. With this, we have secured over the next 20 years a crucial asset to make a considerable difference in network quality and hence offering the best mobile experience to our customers. Another big step in our gigabit network strategy was taken with the announcement of our ambition to broaden our fiber coverage. We agreed an MOU with a consortium of Belgian financial partners to bring high-speed connectivity to the country's low-populated areas. The envisioned off-balance sheet structure has the ambition to reach 95% of the population with fiber, this by 2032. It will reinforce our position as leading fiber operator in Belgium, and it will generate financial benefit from a broader fiber scale, including also cost benefits from copper decommissioning. We aim to reach a final agreement by the end of the year. Today, we are already rolling out fiber in 62 cities and municipalities, and we are well on track to reach our target of 22% coverage by the end of the year. In June, we crossed the 1 million mark of homes and businesses passed with fiber, highlighting the fast expansion of our fiber network. Customer demand for fiber is increasingly higher, with also the fiber price increase having landed very well. I think we all agree digital technology has become essential, and this is certainly also true for our B2B customers, for which we continue to develop innovative offers. This through the new partnerships or through the co-creation of new solutions on 5G, with on the right of the slide some recent examples. In a context where cybersecurity becomes increasingly relevant, we are proud to announce our partnership with Microsoft for the development of a sovereign cloud solution. For smaller businesses customers, we announced our partnership with Odoo, providing our customers access to Odoo's full suite of business applications. Now turning to our international business, and let me start with Telesign. Clearly, we regret that the broader economic context and impact on financial markets hampered the envisioned public listing. Telesign is, however, continuing its strong commercial performance, and we remain fully supportive of its growth trajectory. We are considering our options, and we'll get back to you on this once this crystallizes. For BICS, there was good news on the closing of a multi-year commercial agreement signed with the international communications company Ooredoo Group, for which BICS is now becoming the trusted partner for communication services. A great proof of the quality provided by BICS and by its team. As the last point of the strategic part, a few realizations in the ESG domain. What I would like to highlight here is our announced ambition to provide at least 15,000 charging points for electrical vehicles by 2028, which we see as a very nice and relevant side opportunity of a fiber rollout plan. Turning to our second quarter's results now, and starting with the domestic segment. Overall, the past quarter was not the most intense from a commercial perspective, as I said, but did not have the big promotion as we had last year in view of the European Football Championship. So in this context, we are able to take a big portion of the market growth, which again confirms we have been doing the right things. One of these things is the focus on convergent offers, with Flex continuing to do a great job in attracting multi-mobile customers. An additional 84,000 customers opted for one of our Flex offers in the second quarter, and as such, we have now crossed the 1 million mark. The traction of multi-play offers remains an important revenue driver for residential unit, which closed a very good second quarter, with its total revenue growing by 4.3% from the year before. This was supported by the inflation-driven price indexations, the remaining 2 months of inorganic contribution of Mobile Vikings, and higher revenue from mobile handsets. Zooming in on the services part of the residential unit, we have posted in total a 3.3% growth, sequentially improving from prior quarters, driven by better ARPC trend. As shown on the slide, if we put aside the impact of Mobile Vikings, the ARPC was up by 3.7% on an organic basis. Turning to our business unit, which closed the second quarter with a 0.6% revenue growth, mainly resulting from a firm revenue increase from internet services and also higher IT hardware revenue, partially a one-off, but we also see some of the previously delayed product contracts catching up. Taking a closer look at the business services revenue. All services combined, we post a slight decline of 0.4%, so roughly the same trend as from the previous quarter. Revenues from fixed data, mobile, and IT services were up year-on-year. though was offset by the fixed voice revenue erosion, which is losing the support of the temporary vaccination center-related traffic linked to COVID crisis. And finally, our wholesale unit, for which the revenue from fixed and mobile wholesale services was up by 20.1%. This was offset by the headwinds on the interconnect revenue, which, however, no meaningful margin impact, as you know. This brings me to the total domestic revenue, for which we achieved 1.9% growth for the second quarter. As for the domestic operating expenses, we faced a significant impact from increased inflation, especially on the wages, which have now increased 4 times since October last year. As illustrated on the chart, we have been able to offset most of the inflationary effects by our cost efficiency program. The remainder of the cost increase mainly reflects customer-related OPEX and costs related to the ongoing company transformation. Moving to the results of our international segments and starting with the strong achievements of BICS. BICS closed the second quarter with its EBITDA up from last year by 25.5%, driven by strong margin growth in its core services, more precisely messaging and mobility services, and another excellent performance in cloud communication services. Our second international business, Telesign, continued its strong commercial trajectory of the last quarters, resulting in strong revenue and direct margin growth for the second quarter. Commercial indicators such as the net revenue retention rate remained solid at 125%, and the momentum was also supported by further geographical expansion, as well as the launch of new services within the digital identity suite. Overall, these results reflect the success of the strategic course the company has taken to reinforce its position in the digital identity and communication market. This brings me to the group view. As illustrated on the slides, we are closing a good first half of the year, with all 3 segments growing revenue, overall leading to a 0.7% growth in group EBITDA. Our CapEx remains fully in line with our projections, with the increase on last year largely resulting from the accelerated fiber investments. This brings me to the free cash flow over the first half of 2022. As shown on the graph, the 2 main drivers of the low free cash flow so far are 1, the higher cash out for CapEx, and 2, an unfavorable year-on-year evolution of business working capital needs. Our financial position remains very sound, and we remain on track to maintain our full-year net debt level around 1.6 times. Also, longer term, we have secured our debt, and we have hedged our exposure to rising interest rates through 2025. In conclusion, I'm overall very pleased with our achievements over the first half of the year. Our domestic business is delivering better than expected ARPC and churn, which is very supportive for the offsetting of inflationary effects we are facing. And in addition, also our international businesses are performing better than anticipated. So hence, we're in a good position to raise our outlook for the year. We now expect to close the year 2022 with a growth of 1 to 2% for domestic revenue, excluding terminals. For the domestic EBITDA, we expect to land at the upper range of the guidance, and for the group EBITDA is expected to grow up to 1% compared to the year before. Our full-year outlook for CapEx and for the net debt ratio remain unchanged, and with this, I have covered my introduction, so we can now turn to your questions.
Ladies and gentlemen, thank you for joining this Proximus Q&A session. If you wish to ask a question, please press the code 0 and 1 on your telephone keypad, and you will enter the queue. After you are announced, please ask your question. We kindly ask you not to use microphones or headset when asking your question. If your question has been answered, you can remove yourself from the queue by dialing 02. Once again, please press the code 01 on your telephone keypad. So we have our first question from David Wagman from ING. Please go ahead.
Yes, good afternoon, everyone, and thanks for taking my question. So I've got 2, one on fiber and one on BICS. So first on the fiber networks, what is your reaction to the recently announced communication from Telenet by Telenet and Fluvius on their NetCo plans, and especially on their economics? It seems on paper at least, let's say, that the NetCo has more favorable rollout costs compared to Fiberclar or Proximus. So making it potentially, I think, more attractive commercially to access seekers. So is it a view that you would share, or rather, why not? And how do you hope to make a difference, so to attract access seekers to Proximus standalone network or to Fiberclar? That's on fiber. And second, on BICS. So could we zoom indeed on BICS and strong performance to better understand the sales and margin dynamic at play in this Q2, but also going forward, so in coming quarters and in the years ahead, when thinking about the different trajectory of legacy, core, and growth sales. So what is structural, what is not, etc. Thank you.
I start with the first one. So it was expected that Telenet and Fluvius would come to an agreement. I would obviously not comment on the agreement of Telenet and Fluvius on their economics, but what I know is that there is no magic in rolling out fiber. You need to trench, you need to go on facade, you need to deliver the network to the end customers, and that is costly. And I don't see why they would not bear the same kind of cost that we are bearing for rolling out the network. And we have good experience now because we started 5 years ago, and now we know what it costs to roll out the network in Belgium. And there is no, especially in this context, in the new context we have since a few quarters. There is going to be no magic, no surprise, and they're going to have the same kind of cost that we do have to roll out the network. I have to say that for the moment we are really delivering the acceleration plan of fiber according to our plan. We are making a lot of rapid progress. Now we have a run rate of 10% of additional new Belgium homes per year because we are starting the summer with that kind of run rate, and that is going to be like that for the next 8 years. So I think that's always the same, strategy that we want to deliver. We be the first to plant our fiber flag in every cities and municipalities of Belgium, with a view to cover 100% of the country. That's the plan we have, and then we're going to benefit from a copper-free company because we want to get rid of copper by 2035, and that will create a lot of opportunities for us to further reduce the cost to operate and to bring, more importantly, better services to our customers, being B2B customers or B2C customers. So we are delivering on our own strategy. I think we are, we have the time advantage. Still a lot of paperwork to be done for Telenet and Fluvius to come to live state, regulatory approval, talks with communes. So it will take some time, and during that time we are accelerating and delivering more and more plugs to Belgium homes, and that's for me a key advantage that we have. Just one last comment on this. As I always said, we will also be pragmatic and rational in the approach, and I think this is also the message that they convey. So we're going to be also a pragmatic. We're going to have a pragmatic approach in that initiative, but with a view at the end of the day to own our network, to deliver a fiber solution to 100% of the Belgian citizen.
Maybe a very quick follow-up on this one, on the, let's say, being pragmatic. Do you view any regulatory headwinds, or have you been discussing with the regulator on, let's say, the less dense area to see what is possible in terms of cooperation with other players? Thank you.
I think for the moment this is really statement that we all make, that we have to have a rational approach in the less dense areas because there is not a lot of sense or economical sense to roll out two networks. At the same time, there is no regulatory framework to organize this kind of discussion. So we want to, of course, to be pragmatic, but we have also to comply to the competition framework of the country and also the regulatory framework. So that pragmatism is going to be executed in that context, and that's the only thing I can say.
So you're already negotiating or discussing with the regulators? I mean, to get such a framework, a new framework, I mean?
I think we will come back to you when we can share more.
Sure. Thanks.
I'll take the BICS question. I'll start the BICS question. David, thanks for the BICS question. I think it's great to recognise BICS. I think we come off of 5 straight quarters of growth now, top line and EBITDA, and Q2 was the strongest EBITDA quarter of those 5. So as you can tell, we're super pleased with the performance. In terms of the kind of constituent parts, the core part of the business, the mobility services, signalling, messaging, enjoyed continued growth, sequential growth. So there's a part of that supported by the return to travel that we're seeing pretty strongly over Q2, and that's certainly progressing into Q3 as we go into the main holiday period. In terms of the cloud communications, the growth part of the business, again, we've seen double-digit growth on that business with particularly strong demand for cloud comms from our enterprise customers, and you can see that in the earnings presentation in terms of our exposure to enterprise customers versus telcos is significantly ramping. And then legacy, a business that has been declining, we had growth in the quarter, and again, destination mix of where the legacy voice is being delivered and the travel return to travel is helping there. So and I'm sure we're going to get guidance questions on that, but I think the business is performing really well, and but as you know, there is some volatility in some of that traffic mix, and so we're cautiously optimistic for the rest of the year. But that was one of the parts of where we got to in terms of upgrading the group guidance. Matteo, I don't know if there's anything else you'd add to that.
No, not really much to add, just to say that if we compare to prior to the COVID, basically BICS performance has reached the same level as 2019, but the mix is very positive because it's more structured, more recurring business compared to the past. So growth has replaced basically part of the legacy voice. So that is the underlying message.
And on the margin mix, could you make just a comment on the difference between growth, legacy, and core?
David, we haven't gone to that level of disclosure, so we won't. But it's positive, in terms of, as I said, the overall business is outperforming our expectations, and as Matteo says, the recurring nature of that business. Specifically on the growth side, we're particularly pleased with. So.
Okay, thank you, guys.
So we have another question from Nicolas Cote-Colisson from HSBC. Please go ahead.
Hi everyone. My question is on the Telesign. Obviously, the IPO didn't happen, and the funds were to support the expansion. So, should we assume lower growth and maybe less ambitious growth margin or EBITDA margin forecast now that the process is aborted? I also wondered if you were to face any legal costs, or fees after the cancellation of the IPO. I've got another question, but I may let you answer this one first.
Okay, yeah, thank you, Nicholas. Clear. I think as you saw in Q2, Telesign continued to perform right in line with what we told the investment market back in November, while we were going through the preparation for the IPO. So we've seen again, internationally, we're super pleased with the way the businesses are progressing. Telesign has really matured from a management perspective, from a strategic and execution perspective, and you can see that coming through the numbers. The company was ready for IPO. The market just wasn't there, and that's clear. So in terms of do we see any slowdown in that? The business is executing exactly as we expected to. In terms of, you'll see some of the EBITDA, primarily better in the first half, primarily because the ramp up OPEX is more phased to the second half of the year. But again, we don't see any material issue in terms of the performance or execution of the growth plan without the public listing at this point. In terms of fees, there's nothing material, so everything was success based, and there's no material element of kind of post the closure of the process with NAC.
Okay, thanks for the precision. But if I remember on the slides, the IPO slides, the 2026 revenue of $1.1 billion was quite aggressive. So obviously it's a long time from now. But so should we keep in mind the same kind of growth profile, not just for H2 or 2023, but beyond?
I think the objective to get to a 1 billion company stays, and that's really the commitment of the management team, and that also our views. We want to get there and to grow that business towards that 1 billion threshold, by 2026. So that commitment is still valid.
Okay, thanks. That's very clear. So maybe just a quick follow-up on the market. Obviously, it's been a supportive market in Q2, but still, I noticed a spike in churn in your 4-play stats. I was just wondering if it was just a one-off, or if it was saying something about affordability and people trying to cut the cord a bit amongst their products.
So, Nicolas, on the 4-play, 3-play, and the related churns, this is the continued pressure that we see on fixed voice, which quarter over quarter continues to impact the movements from 4-play to 3-play, and we indeed see structurally a better market traction on our Flex triple play offer rather than the Flex 4-play offer. So that part is going to continue to go into the numbers going forward.
Okay, that's very clear. Thank you.
So we have another question from Ulrich Raj from Jefferies. Please go ahead.
Thank you. Maybe one follow-up on the fiber question. Is this, in the big picture, is this now essentially a rat race where you roll out and Fluvius roll out and then sort of see what happens? Because it's a bit difficult from the outside to see how two networks can be rolled out to at least 80% of Flanders, and both of them making proper returns. So I suppose the question, in simple terms, is it, can you envisage a situation where there would be two networks covering 80%, both making returns, or is it more a question of who wins in the way to get there now? And the second question is, you're talking much about the staff costs in the context of inflation, much more than in energy costs. On slide 39, it's sort of showing that the energy cost inflation is very minor. Could you talk a little bit about the outlook into 2023 for that? And if I may squeeze in a third one, when you mitigate the wage cost, I suppose the one lever is to get the headcount down. Well, are you increasing early retirement offers at the moment? Is the cost of those offers going up, or are these things essentially in place and you're counting on the sort of gradual take up as it has happened in the past? Thank you.
So on the fiber, the fact that Telenet and Fluvius did announce a partnership last week was not a news or a surprise to us, and in our ambition to deliver 95% of coverage of the country, we of course took into account the probability that to see some overbuild coming from other players. Does that mean that you're going to see overbuilt in all parts of the country? Probably not, because this is not something that is rational, and I don't think that overbuild is going to be fully there, especially on the less dense areas. That's why I think the speed to roll out in those also in those geographies is important. Are you going to see some overbuild in the more dense areas? Probably yes, because this is something that is happening in every market. But again, we are at full speed. We are rolling out 550k plugs this year. Is going to be even more next year. So we are delivering 10% of Belgian homes every year with good partners. with a fully funded plan, and with at sight the ability for us to become a copper-free company, and which is super important for us in order to also transform the operating cost of the group. So with those kind of ambition, we are super enthusiastic about the prospect of putting in the ground the fiber network as a key element for future growth for the group.
Let me take your energy costs. So, in terms of, as you know, 2022, we're pretty much fully hedged. So we have no material impact there. In terms of 23, I think last time we spoke, we were around 50% hedged. We're now up to 75% hedged for 2023, and we're monitoring it every day in terms of kind of opportunities to buy. In terms of the overall exposure, it's probably a kind of low double-digit impact for 2023. But as I said before, we continue to kind of look at various ways from our efficiency program to mitigate those things. In terms of the overall workforce, you're right. We continue to be very focused on the overall number of internal workforce. In terms of we still consider customer supporting and direct billable FTE very carefully, but the overall number is going down. In terms of any program, we don't have any program to accelerate pensions or any additional costs associated with that in the plan. So that's where we are right now, and clearly we also have a significant external workforce which we're also very carefully managing to mitigate overall costs.
Thank you very much.
So we have another question from Roshan Ranjit from Deutsche Bank. Please go ahead.
Great afternoon, everyone. Thanks for the questions. Got three, please, hopefully very, very quick. You've seen the pricing support come through, which is driving your top line guidance increase. That's clearly indexation led, but is there a consideration to maybe put the underlying price of the fiber product up, given that you've seen a good take up in the areas, and as you're rolling out, you are seeing higher kind of penetration in certain areas? So is there a case of, I guess, increasing that fiber premium? Second question on the enterprise or the business unit side is, we've seen a number of peers this week cite a weakness in enterprise. I mean, that's clearly different from what you guys are seeing. Is that a case of maybe the corporates in Belgium or your end kind of customer, or are you guys further through the mix of that legacy versus new products? Because I think a couple of years ago you were embarking on that big shift within the enterprise segment. And thirdly, just touching on some of the previous questions on fiber, you announced these two further JVs, and that extends the fiber coverage. Was there a consideration to maybe accelerate the coverage? So you still got this 70% target by 2028. Was there a consideration to say, 70% by 2026? Did that ever come up in discussions or not? Thank you.
We will let Jim answer the last part of the first question, but the good top line on consumer is, of course, the result of the price indexation, but it's way more than that. It's just like it's not like you decide to do price increase and everything is suddenly happening as a miracle and landing on the revenue of the residential segment. This is way more difficult than that. I have to remember that there is no contract in Belgium. So there is no commitment, so you can leave Proximus tomorrow if you want to. So it's way more than just that. It's the product superiority on which we are putting a lot of effort and investments on fiber and mobile. This is the improvement of the NPS. You see the trends on the NPS that are favorable and that are continuing to bring better customer satisfaction, despite the fact that we value managed during the quarter. And of course, we we have some also some good volumes in a market that was quite not that active in Q2. But if you look at the performance of Proximus, we are clearly winning the vast majority of the customers on mobile and half of those in internet. So. Just to put a little bit of context, it's way more than just deciding to increase prices. This is way more than that is driving the good performance of the residential segment. And last, and then I will really let Jim answer that question. Also, the strength of our brands. If you look at the Proximus brands over the last 3 years, we improved a lot the perception of the brand. And that will continue to pay off in the coming quarters. That's for sure.
So Rashan, on maybe adding on that on the fiber part. So fiber indeed is bringing a better experience, of course, to customers than on copper technologies, and that's already reflected in, I would say, the base pricing of our fiber flex versus the flex that we are delivering on copper technology. Next to that, also. Thanks to fiber, we can introduce a new kind of tiering that we didn't have on our copper technologies, which is a tiering based on upstream and downstream speeds. So we already have today, next to our standard offer, a 1 gigabit solution in the market, which is tiered at a higher price. It's 12 euros more than on copper. And then next to that, as you know, by the end of the year, we're also going to launch the 10 gigabit solution on fiber, which is again going to be a way to increase the value that we're getting out of fiber customers. So we're really also there already today, indeed leveraging the quality of fiber to get as much value as possible for our customers, and this is reflected in the pricing, of course, as well.
So maybe I shall take the enterprise question. So this is Anne-Sophie Lockring. I'm responsible for the enterprise business. So thank you very much for your question, Rohan. I think there's a couple of highlights I could provide you. So as you know, we're in the midst of our transformation and our strategy to become an ICT convergent player. So really benefiting from our telco DNA, but also with our IT expertise. And we're offering our solutions to our customers in an end-to-end way, i.e. completely correlated with the network, or in over-the-top play, which is completely independent of whatever infrastructure our customers have. And to do that, we also have a very segmented approach, which of course goes more and more into packaged industrialized offer, the lower down you go into the market towards the SMEs. Now, I think it's by focusing on our convergent solutions that we're able to mitigate the telco decline. And if you look at our results, we continue to keep our good momentum in fixed data, thanks to both PARC and our pure growth within Internet, but also within data connectivity. And within data connectivity, we have a good balance between, on the one hand, our growing fiber PARC, and on the other hand, our legacy outphasing and migration towards SD-WAN offers, with an attractive customer connectivity pricing. So overall, I think we see here the results of this ICT convergent strategy really paying off so far. Thank you.
And on fiber, the new agreement we have with our partners to get to 95%, as we said in the announcement, is going to be in parallel. So it will go in parallel compared to what we have previously announced, with an acceleration, of course, in the later years. So it might be indeed that, but we want to first to finalize the discussion. It might be indeed that 70% is going to be more than 70% as a mechanical effect of rolling out more plugs with new partners during that the time frame between 2023 and 2028. But we will come back to you once the agreement is finalized, with more clarity on the ramp up of that additional fiber initiative.
Great, thank you. If I may just follow up there. So whilst we wait for the details on the additional point, was there a discussion to bring forward, I guess, the original plan, which, if I remember correctly, you gave back in 2020, i.e., the 70% being brought forward earlier? Could that be a case?
No, we will stick on the original plan as far as the Unifiber, Fiberklaar, and Proximus own development are concerned. And on top of that, we can have the new agreement in between Proximus and its new partner for the less dense areas that will come on top. But the initial plan is not going to be affected by the new agreement.
Okay, understood. Thank you very much.
So we have another question from Polo Tang from UBS. Please go ahead.
Yeah, hi, thanks for taking the questions. I have two. The first one is really just about the spectrum auction. Now that it's over, what are your latest thoughts in terms of the impact of a new entrant and the range of outcomes? So do you think that Belgium could become the new Italy, for example? Second question is really, can you talk through the phasing of your domestic EBITDA growth through the rest of this year? So, for example, should we expect it to accelerate as you benefit from price rises, have easier comparables, and realize synergies from the Mobile Vikings acquisition? Alternatively, are there offsets and headwinds to consider? Thanks.
On the new entrant, I think what we can say that we're going to be fully prepared for that new entrant when he will enter the market. The rest you should ask to Digi, because we don't have the plan of Digi, so it will be a bit depending on the way they want to position themselves. But what I can say, because I've been there before, we're going to be ready for it. Both on the enterprise segment, but also on the customer segment.
Although on the phasing of the EBITDA, clearly the guidance we've just given shows implied acceleration of the EBITDA in the second half. I think the key components you hit, right, the price rise, we're pleased with how that's landed. The churn's been positive. We continue to see commercial momentum, so that we expect to continue. Mobile Viking synergies will fully analyze it in the upcoming quarters. We've got effectively the inflation offsetting by the efficiencies that we're putting through from a management perspective, and then we are going to face some easier comps in Q4 on an OPEX perspective. So I think that's the way you should think about it in terms of the phasing for the rest of the year.
Thanks.
So we have another question from Ben Lyon from Credit Suisse. Please go ahead.
Hello, thank you for taking my questions. I have two. The first one is on the rural fibre JV. It seems like the economics are a little bit more difficult given the rollout cost. Could you give us an idea of whether you're having to offer higher wholesale rates, or if you're expecting others to join you in that in order to attract a third-party capital? And my next question would just be on the fibre ads. Can you give us an idea of how many of these are win-backs versus migrating the current customer base? Thank you.
I think on the rollout cost, again, I'm going to repeat what I said. There is no magic. If you want to roll out fiber network, you're going to bear the same kind of cost that we are having today. So there will be no difference, except from the fact that we are started before, that we have long-term commitments with construction partners. That includes also the effect of inflation, and launching this kind of initiative today in a high inflationary environment is probably more difficult compared to the situation we experienced 4 years ago when we started to accelerate massively the rollout of the technology, of this new technology.
Maybe as an addition to that, in fact, we have been tuning our topology to the specifics of the area where we roll out. So in high dense, we're rolling out in point to multipoint, which makes that there, due to the fact that we can optimize better for less trenching, more on facade, in fact, that topology should bring higher efficiencies than doing it in P2P. So we have as well a combination of trenching, facade, but now as well pylons, and we make the combination of those three to get tuned per geographical area, really the best costs and the highest efficiencies.
And then on the fiber net add. So as you know, we are indeed doing better in terms of acquisition in fiber zones. At the same time, we also know that we have lower churn in fiber, and then we also migrate our existing customers, and this is indeed bringing the net adds. We're not disclosing, of course, the details of how much acquisition we're getting in that fiber net add, but you can assume that we are able to migrate about 65% of our customers in the first year after we deploy fiber in a certain area.
Thank you. That's really helpful. If I could just have a follow-up on the fiber JV. I mean, if I just look at the sort of 4 billion euros that's committed, that kind of implies a more than 2,000 euros a home cost. I mean, just in terms of that, I mean, would you have to charge the same kind of wholesale rates that you're charging on the other builds, which are much closer to 1,000 euros a home, or is that the wrong way to think about it? Thank you.
I think that at the end of the day, the market is not going to be regional. You can have one price for fiber in every part of the country. So you're going to have to do some perequation at some point, and that's why we also believe that having an active access to the network is also a good way to get access to the fiber plug that we're going to have rolled out. But that's another story. But indeed, at some point we're going to have to manage globally, nationally, the effect of having different costs to build the network. It's super cheap in Brussels. It's less cheap in the less dense part of the country. But they're going to be only one price for accessing the at the retail side, the fiber technology. So. That's not unusual to do to deal with that different cost of building a network in different geographies. This is the story of the telecom industry, and we're going to manage that in the same way we have managed mobile cost and copper cost.
That's really helpful. Thank you.
So we have another question from Joshua Mills from BNP Paribas Exane.
Hi guys, thanks for the question. Hope you can hear me. I also want to ask a bit more about the working capital. So obviously we saw a big negative outflow this quarter, and I think on the Q1 call you talked about the fact that working capital outflows were partly to do with phasing. Now you're talking about unfavorable year-on-year impacts on business working capital. So my question is, could you give us a kind of soft steer on where you expect working capital to end at the end of the year? I think consensus is still expecting it to be a positive contributor to your free cash flow in 2022. So it'd be great to know if you think that's still the case. And then, somewhat related to that, Mark, I think on the last call you made the point that whilst you don't give a clear guide on free cash flow, an explicit guide, you were comfortable with the 200 million or so that consensus is at currently. We'd just like to understand, how that may or may not have changed given the higher EBITDA guidance on the one hand, but potentially some of these working capital headwinds if they don't unwind in the second half. So great to hear your thoughts there. Thanks.
Cheers, Josh. Thank you for the question. Yeah. So look, I think again, continuing, there are timing differences continues into half one, right? So I think if you looked at our 2021 working capital, it was specifically positive related to timing of some expenditures in 2020 and 21. So I think that we're still cycling against some comps from a working capital perspective that made H1 from a working capital perspective look more difficult. I think what I said on the first call is that overall working capital and tax payments would be net positive for the year, still kind of in that place. And we're just going to see the benefit of that come out in the second half of the year. I think the way you should think about it, though, is we're also thinking through the overall supply chain constraints that we're seeing. We continue to see some of that, and therefore there will be some inventory build up as we kind of make sure that we've got the right equipment for customers in the second half of the year and into 2023. So I think that's possibly a little bit of something we continue to consider and may weigh marginally on consensus. But as you know, we don't give overall free cash flow guidance. But that should possibly help you get to what we're thinking of.
Okay, so just to be clear, Q1 the view was still that this could be a tailwind, depending on what you do with managing supply chains. That may not be the case now. But maybe could you just give us a practical example? I think, as I understand it, you're doing things like paying bills in early to try and avoid price rises in the future, maybe buying some handsets. Is there anything else going on here that you could draw attention to and explain why managing that working capital in this way could be a positive?
Yeah, I mean, I think, interest rates are changing, so the way that we think through, the cash management is clearly something that we're considering, and this time versus this time last year is we're in a bit of a different environment. I think in terms of the inventory, handsets is one way of thinking, but also, customer equipment for our consumer business and also our enterprise business is another thing that we're, making sure that we have adequate supply so that we don't have any disruptions on the commercial side. And we feel very positive being able to do that, but we're being thoughtful about how we do that in the second half of the year. And that has the possibility of some, as I said, smallish medium effect on working capital.
Got it. And sorry, just one very final one, if I just to size it maybe. I mean, obviously you're upgrading EBITDA guidance, which would imply a tailwind to the free cash flow this year of maybe 18, 30, 20 million, 30 million. Is that the kind of delta we should expect maybe of additional working capital investment, or are we talking about an even bigger amount which might be coming in the second half?
I should say we don't guide, but the EBITDA guidance group will not be additive to the free cash flow consensus. So I think that's the way you should think about it. And as I said, I think we've still got to make the full decisions on any inventory. So we'll see that as we go into the second half of the year.
Great, very clear. Thank you.
So we have another question from Yemi Falani from Goldman Sachs. Please go ahead. Mr. Yemi Falani from Goldman Sachs, your line is open. You can ask your question. So we are going to the other question from Martin Hammersmith from Citi. Please go ahead.
Yeah, thanks for taking my question. And apologies if some of them I will repeat as my line dropped at the beginning. So the first question is on Telesign. And in your presentation, you basically stated that Telesign is ready to be publicly listed when the time is right. Would you also consider just having an outside investor and keeping it within sort of the Proximus perimeter? I mean, you would have done that within SPAC, but do you need to take it public, or are you looking sort of at other alternatives as well? And then the second question is on the dividend. I mean, you're running against sort of the end of a 3-year cycle, and your dividend is yielding somewhere like 9%. Can you share with us sort of how you think about the dividend? And I know that it might be a thing for the CMD at the end of the year. But do you feel comfortable sort of not fully covered for a couple of years, knowing your capex will come down soon and your leverage is rather low compared to some of your peers? So just your latest thinking here would be greatly appreciated. Thank you.
Martin, let me thank you for the question. Let me take on the Telesign one first. So I think the ambition to create a currency for Telesign for the various reasons, for whether M&A or for internal staff talent traction, all the benefits of being public still are very attractive to us. So I think that's and I think 12 months on, the company is ready, the strategy is being executed, the company's performing. In terms of the various routes that we can look at, I think we've got, as the earlier question, we're free of any obligations from the NAC process, the SPAC process, and so we have various options that we can explore down there. And as you'd imagine, we are looking at what the best option is, and there can be a combination of options over time. So I think that's the way that we're thinking about the overall Telesign asset. I think net we're just really super pleased with the change we've enacted and the management have enacted in that business over 12 months. So that's really where we are on the future. We've got optionality, but the IPO was there was a reason for why we were thinking about that. In terms of the dividend, I think I think you answered your own question. I think, look, we've always had this view of being comfortable being back to dividend coverage over the medium term. We're super pleased with the progress of the business as we kind of exit half one, and that's why we've taken the guidance up. And look, we're currently in the middle of our kind of next 3 to 5 year planning cycle, and that question you're asking is one that we'll give due consideration of given the strategy that we're putting together. So I think that's where we are. You will absolutely get an update in the Capital Markets Day in December, and look forward to talking to you about that at that point.
Thank you very much.
So there are no more questions in queue. We will therefore hand over the call to Nancy Goossens, Director of Group Investor Relations, for closing comments.
Just a big thank you to all of you for your questions and joining us. And as always, should you have any follow-up questions, you can send those to Eileen or myself. Thank you very much. Bye.
Ladies and gentlemen, this concludes today's conference call. Thank you all for attending. You may now disconnect.